Alrighty, we are ready to get started today. How is everyone doing today? Hope you are doing well. My name is Andrew Kuhn. Thank you very much for tuning in with us here today at the Focus Compounding Podcast. Mr. Geoff Gannon, how are you doing today?
I'm doing great, Andrew. How are you doing?
I am doing fantastic. I'm always waiting for you to say how are you doing. I am doing great. So today we have a very special guest on. He's also a Dallas native, if you could believe it. Samir Patel from Askeladden Capital. He is on the line. Samir, how are you doing today?
Doing pretty well. Thanks for having me, Geoff and Andrew.
Hey, man, thanks for coming on. I think, there's this, you don't have a Twitter, but I did see some people tweeting about, I think your pitch deck one time or something along those lines. So people definitely know that you're out there. And I think this will be a great sort of avenue for you to sort of talk about your investing style. You definitely have sort of a unique background. And I've talked about on the show before how I'm sort of fascinated with this idea of stories and how everyone has their own unique story. The narrative's always being written, and there's no one perfect story to life. And how certain things could change in our lives, and we end up doing completely different things, and it's all an interesting story. But today we're going to be talking about your story. I was doing some research on you, and
oh wow, no, that's not good.
Yeah, I know, right? Google, I know. And they called you the Dan Marino of spelling, and you were that.
Hey, I always preferred the Tony Romo of spelling first of all, but go ahead.
Being in Dallas, and you were that kid from the spelling bee. And I don't want to talk about your past. I think that's a good avenue for you to talk about your past, but just sort of give us a little background on you and your childhood and sort of how that came about. So tell me about the spelling bee and kind of go from there.
Yeah, so I mean, I competed in the National Spelling Bee 5 times in a row from, I guess it was 2003 to 2007, and I placed third the first time I went and placed second the third time I went. And yeah, it was kind of interesting. It started off being something that was almost completely accidental in the sense that, I was maybe 6 or 7, and one day a friend of ours just mentioned, hey, there's this spelling bee for Indian kids. And Samir kind of, knows a lot of big words for being, 3 feet tall or however I was. So they recommended that I went and, did this. And so my mom took me, and I did okay. It's called the North-South Foundation, and it's I guess a nonprofit that is designed to kind of raise scholarship money for underprivileged students in India. But anyway, they host spelling bees here in the U.S., and I actually came in 4th at the local level, and I think I was 7 at the time, and only the top 3 got to go to the nationals. But because I was like 6 or 7 and everyone else there was like 12 or 13, the conference organizers, I guess, made an exception. And so I went to that. And so long story short, I ended up winning, mostly by luck, kind of that one. And so then I decided to move on to kind of Scripps, which is the, actual kind of real spelling bee. A lot of Indian kids use the North-South kind of as like a training ground for Scripps. And so then I went and competed in Scripps. And so I did that a lot. And it's kind of one of those things where it's been this part of my life that has been both frustrating and also amusing, in the sense that, like, for years and years and years, people would be like, oh, you're that kid from the spelling bee. And there's definitely a period, especially kind of in high school, where I was like, look, I feel like I'm doing a lot of other cool things in my life. Can I please get past this stupid thing I did when I was, 11, right? But so it's still surprisingly something that people decide to bring up. So here we are talking about it.
It's just so interesting, and it's quite fascinating. And so you started that when you're 6 or 7 years old. And how old are you now?
24, turning 25 in January.
Nice. So from there, you've talked about, and I read on your LinkedIn, how you were homeschooled and how you plan to homeschool your kids, and how you thought that it was pretty impactful and great for you growing up. What was it about homeschooling, do you think, that sort of gave you that advantage, I guess, to excel? I mean, maybe you could sort of talk about that.
Yeah, sure. And you know me, Andrew, I'm gonna talk about mental models because that's what I always talk about. But so I think what I really got out of homeschooling is, I guess you would talk about utility and opportunity costs, right, in terms of the mental models. So in school, you get to, the benefits are that you're kind of in a group with your peers and you're sort of advancing at the same pace as them. And so you have kind of a natural platform on which to form, relationships that last at least for the duration of school and hopefully longer. when you're homeschooling, you don't necessarily have that, so that's kind of what you're giving up. But what you're gaining, the trade-off, is that you can advance at your own pace, and you don't necessarily have to follow the same curriculum that everyone else does, right? So kind of a net of that is that by the time I was 13, I had finished. I mean, I skipped like a grade in elementary school. I mean, grades don't really mean much for homeschoolers, but I'd basically done like algebra and geometry by the time I was 13. Because in addition to the spelling bee, I also did math counts in middle school, and so when I was 13, I basically started taking dual credit community college courses. And so in 4 years of, quote unquote high school, I basically just did a lot of dual credit courses at a community college and graduated with an associate's degree when I was 17, which is how I was able to go to, real college and get my bachelor's by the time I was 19. So I think there were a couple things that came out of that, right? And one of them is just looking at the world kind of in a little bit of a different perspective where I don't always assume, like when I was homeschooled, right, it wasn't a standard like 9 to 5, okay, you go to school at this time, you get out at this time, you go to school Monday through Friday, and then you have the weekends off. And then you have the summers off, and you have 2 weeks for Christmas break. We didn't really take summer breaks, right? But at the same time, on a Tuesday afternoon, if it was a nice day, we might just not do anything and go to the park. And clearly that didn't retard my development as far as getting through all the schoolwork I needed to. And so I think that really carried forward in the sense of, when I got into the workplace, I was just sort of astonished by, first of all, this very kind of linear, like, okay, the work week has to be 9 to 5 at an office, and, you work weekdays and you don't work weekends, and you get these holidays off. And so then B, the other thing is that I've never really kind of taken seriously sort of the very standard, like, okay, you're going to spend 2 years doing this, and then you're going to spend 2 years doing this, and that's just how your career progresses, right? I kind of am focused on progressing at my own pace. So I think that's what I really took away from it, is this focus on utility and this focus on, maybe not necessarily doing things the way that they've always been done or the way that people tend to do them, but rather the way that makes the most sense and allows me to kind of derive the most value from what I'm doing.
Wow, that's absolutely incredible. So was it your mom that taught you?
Yeah, no, it was definitely, I mean, my mom, so, my parents made the decision to do this pretty early. And again, that was, you talk about stories, that was kind of one of those serendipity things where I have a late birthday, being born in January, I'm kind of cut off from going to school, that year in kindergarten, but I was kind of ready for it. But my parents just had to keep me at home, and I was getting bored. And, my mom was taking me to some gymnastics class or something at a local rec center, and ran into some homeschoolers who were, had their books open. These kids aren't in school. It's the middle of the day. And she's like, I wonder what they're doing. And so that's kind of how they got into homeschooling. They're like, okay, we'll try it for a year. And then, just kind of went from there. And I never ended up back in a public institution of school until, community college when I was 13. So
wow. What was that like, being 13 years old and I guess being with people in class that are, way older than you?
Yeah, I mean, it's funny. I think probably less weird than it seems in retrospect now.
Yeah.
I guess at the time
you were literally probably that kid,
right? So, I mean, I'd never been in school with like people my own age, right? Like I'd taken a few classes and stuff, but I'd never I'd never even been in a public school environment really. And so I don't think at the time, and of course being 13, like you don't necessarily see things the same way you would as an adult. So, at the time it was just sort of like, okay, this is what I'm doing. And, it may not be what everyone else is doing, but I've kind of never really done what everyone else is doing. So I don't think there was a lot of awareness until I kind of got older. It was probably more when I was like 15, 16 that I started to realize like it was kind of hard to make friends with some of these people because they could drive and I was still having to rely on my parents to drop me off places and, things like that.
Okay. So you come out, you're 17 years old, you have your associate's degree, and where do you go from there?
I went to UT Dallas here in the DFW area. So I was actually planning to go to A&M, but they cut their scholarships the year that I was planning to go. And I had two criteria for college. One was that I didn't want to pay for it, and the second was that I wanted them to accept all of my credits because I didn't want to spend 4 years getting a bachelor's degree. And so that basically limited me to in-state colleges, just because any out-of-state colleges wouldn't have accepted all the credit. But the Texas Common Core basically forces all the colleges to accept all that credit. And then the second thing was that UTD offers really good merit-based scholarships, and so I was able to basically get through school without paying for it. So that's what ended me up at UTD.
And then you went on to complete your MBA from there as well, didn't you?
Yeah, because I mean, they gave me a 4-year scholarship, and they were really good about saying, okay, so you're only using 2 years for your bachelor's. Feel free to use the remaining 2 years for whatever you want to, any graduate work or other classes or so on. So that's basically what I did.
So then from there, so now you're probably like what, 22 years old, have your MBA.
Yeah, and I should actually interject that I got really bored with classes, and I didn't see the point. I think like a lot of value investors, and maybe like yourself, Andrew, I've never found formal education to necessarily be the path to enlightenment as far as things go.
Yeah.
And so my second year of school, I was 18. I actually started working full time as an editor for Seeking Alpha, and I was on their Seeking Alpha Pro team. And then from there, the next year, when I finished my bachelor's degree, I got a job with a hedge fund. So basically, for my second year of college, I was working full time. So yeah, I graduated with my MBA at like 20 or whatever it was, but by that time, I'd already had 2.5 years of professional work experience.
So how old were you when you actually started getting into investing, and what was sort of your first forte into value investing? Because it's interesting because I'm always curious to hear about how the bug bit them. Like for Geoff, for example, his father told him about this book, right? It was Benjamin Graham, and that's sort of how he sort of dove into that world. For me, my father was in the business, so from I sort of ended up here as well, and then the value investing bug bit me, and then it sort of opened up this huge world, I guess, of this path that I've been on ever since. So for you, because both your parents, I'm guessing, your mom, taught you, so engineers. So there you go. So they weren't into investing. So how did you sort of start this path that you've been on?
Yeah, so I would say that there's all these apocryphal stories, right, of these value investors who started reading 10Ks when they were, 12 years old, and their juice box would have a little financial filing listed on it. Now, but so I'm kind of the opposite of that, where I think I was vaguely aware that stocks existed. I seem to recall one time telling my mom when I was like 6 or 7, because I'd heard something about the stock market crashing, that when I grow up and I have lots of money, I'm not going to put any money in the stock market. I'm just going to keep it in the bank. Look how that worked out.
How ironic, right?
7-year-old Sammy. But so essentially, I think I got to about 16 or 17, and I'd saved up a few $1,000 just from kind of odd jobs in high school, and I was just complaining to a family friend. She was actually like an 83-year-old Jewish grandmother from Boca Raton. Long story, but I was complaining to her that I was getting like a penny's worth of interest per year for keeping my money in the bank, and she's like, "Oh, you should try this high yield bond fund at Fidelity, blah blah blah, and pays a 6% yield and blah blah blah." And I had no clue what a high yield bond was, but it was sort of the first time my eyes opened to like, oh hey, I have a little bit of money and I can actually do something with it other than put it in the bank. So I started investing in random mutual funds based on absolutely no knowledge at all. It was totally like, oh, what's done well the past 5 years? That looks good. Let's click on that. I started day trading, which was actually it wasn't a complete disaster. I didn't lose all my money, but I certainly didn't make any either. So let's just say that I had no clue what I was doing for quite a while, and then I think what happened is I started writing for Seeking Alpha. And actually, probably more after I started working there as an editor, through being able to, my job as a Seeking Alpha Pro editor was I'm basically spending the whole day reading write-ups by either hedge fund managers or people who are good enough to kind of, write write-ups that are attractive to that audience, because that was the focus of the platform. And so I just leveraged that, in terms of like, okay, learning about how these people think and then reaching out to them, forming relationships, both for the purposes of Seeking Alpha's contributor relations, but then also for the purpose of like, hey, can you give me reading lists, or can you look at this idea write-up I did and tell me what you think, or et cetera, et cetera. And so that's kind of how I got into value investing. And several people. So there's a local guy here in town named Tim Heitman who'd worked for Prudent Bear and a number of other funds. There was a fund manager from the Northeast named Chris DeMuth, who I was really good friends with for quite a while, and he was kind of a special situations guy, event driven, and so I got a nice broad, very broad sampling of different approaches to value investing, ranging from, Chris DeMuth's event-driven approach to, kind of the bargain basement, old style Ben Graham, deep value type stuff to, more of kind of the compounders that's really popular now. And so it was a good place to start and really just be exposed to all those sorts of ideas, and then kind of from there start to figure out like, okay, what makes sense to me? What's a good match? Trade adaptivity mental model. What's a good match to my own unique interests and skill sets? So.
That's interesting. So then from there, so how did you get a job at a hedge fund? What was that experience like for you? And maybe you could sort of talk about that.
Yeah. Let's see what I'd say about that. I would say, first of all, I'm obviously very grateful to the PM for taking, for giving me that opportunity, because I don't think there are a lot of people who would have hired a 19-year-old without much previous experience, right? And so his mentality actually was that, he didn't want to hire the kind of standard pedigreed, Harvard MBA, 2 years at Goldman, blah, blah, blah type analyst, because he figured if he hired the same analysts as everyone else, he'd get the same ideas. And so I learned a lot there. He was a small and micro cap investor, so certainly, getting to go to Roth, getting to go to B. Riley, and some of those sorts of events was interesting and kind of helped provide me with a lot of perspective. I would say at the same time that there were many reasons I decided to move on. I think one of them was there was a little bit of a just mismatch in terms of he'd been a very successful manager, had a great track record, and then had ended up returning a lot of the outside capital, and kind of was at a point in his life where I think investing in public stocks for various reasons wasn't necessarily his day-to-day priority. And obviously for me it was. So I think I needed to move somewhere else to continue my development, basically. Among other things. I mean, that's sort of the abbreviated version.
Yeah. So did you start Askeladden Capital?
Yeah, and there were a lot of things that went into that, and I know you and I have talked about a number of them. But from talking to mentors, and I think as you know, Andrew, right, my long-term goal is not to maximize my total lifetime earnings. It's to live the life that I want to live.
It's to be a good dad. And I got that from your pitch book.
Yeah, no, so that's a big part of it, right? And there's also just sort of the lifestyle things around. We know about my chronotype, and about sort of my aversion to a lot of the typical 9-to-5 type stuff, and offices and dress shoes, and so I think when I'm thinking about what I want to do in the long term, it was always very clear to me from talking to mentors that the path I needed to take was, being in charge of my own destiny. And so what I came to understand from talking to a lot of people who'd been in the business for a while is kind of no matter how much background you have, unless you worked for David Einhorn or Julian Robertson or something, it's going to be very rare for you to kind of come out of being an analyst and then immediately kind of be funded and get a lot of capital. Like typically people want to see you establish your own track record and so on and so forth. So from talking to them, it just didn't really seem like there was a lot of benefit at that point to continuing to work for other shops, and just in terms of what I wanted to accomplish personally, it seemed to make a lot more sense to just kind of go at it on my own. And being young really helped in the sense that look, I don't have a family, I don't have a mortgage, so it's not like I needed to make a lot of money for any specific reason in the next few years. Versus if you delay and then you get a girlfriend that turns into a wife, and that turns into 3 kids and a mortgage, and it's just harder at a certain point in your life to go do something entrepreneurial because you have other people whose livelihood is depending on you, right? It's
sure.
Not just yourself. So
yeah.
So that was sort of what went into. Sorry, I'm tripping over my own tongue here. The decision to start my own firm.
Gotcha. That's awesome. Your structure is as a hedge fund, and also you do manage separate managed accounts as well, correct?
Correct. Yes.
Yeah. Great. And what is your, because you had a bunch of different mentors and you sort of got to view a bunch of different styles. What would you say is sort of your investment philosophy, investment style for your fund?
Yeah, I mean, I think where I've kind of settled out is I'm somewhere between, having probably more valuation sensibilities than a lot of people who focus on compounders. But at the same time, not really being in that deep value arena because I kind of prize business quality. So what I like to say is shorthand, and this is obviously just shorthand, right? But I like to say that I'm equally happy paying 10 times free cash flow for a business that's worth 15 times, or I'm equally happy paying 15 times for a business that's worth 20, right? So I kind of find that the middle is my sweet spot, kind of like those solid, high quality firms that grow, but they're not growthy enough to attract the really high valuations, right? Where it starts to, you have to underwrite kind of a lot of growth going out a long time to justify the multiple. At the same time, I've kind of found that I'm not really good at underwriting the cigar butt type situations, and so I kind of tend to focus on that middle spot, that's somewhere between deep value and between paying a really big multiple for compounders.
Sure, that's cool. And then how many stocks do you typically have in your portfolio? And is it like a long only portfolio? Could you sort of...
Correct. Yeah, no, it's long only. I don't short. I don't use options. I don't, it's really just plain vanilla, kind of bottom up stock picking. Concentration, 8 to 15 names is the target. I've been a little more concentrated since inception than I necessarily intend to be, for forever, but it's just sort of like the current market environment we're in. It's just hard to find really good ideas. So you either kind of have to be willing to buy a little more of the stuff that you really like, or you have to, decide to hold just a lot of cash. And I already have, 10, 11% cash in my portfolio. The target range right now is about 10 to 15. And I kind of view it as an opportunity cost thing, right? Where if I can underwrite something, at a 15, 20% IRR over a 3-year period, it's a little hard to justify holding just tons and tons and tons of cash unless you have some reason to believe there's going to be, a big market correction overnight, which I don't feel like I have any particular insight into, right? So that's kind of where I come out on that. And, my large positions, I think it's fairly well known publicly, but I do tend to take, I'm perfectly willing to take, well north of 20% positions and stuff if I think it's really, really compelling.
Sure. And then is your typical time frame probably more, I'm guessing, more longer term then? Like more than like 2 to 3 years, or what are your thoughts on that?
That's funny. So the way that I always underwrite companies, with very few exceptions, is that I initiate a position when I think I can earn a 20% return over a 3-year horizon. And 20% annualized, obviously. So what I mean by that is that, I think that the company's worth something today, and then obviously I think that's going to compound at 10% a year, for 3 years. And so if you kind of add that discount to fair value and that compounding and look out 3 years, which is what I think it should take at most for the market to kind of recognize what's going on, or for me to be proven wrong, that's how I underwrite things. And I think what's ended up happening is, just due to the environment we're in, I think good news tends to get priced in very quickly. So if you look at my returns, right, I don't think I've had really good performance, and I think that's not so much because the companies I've invested in have just sort of blown past my expectations. I think it's just that the market has re-rated them much more quickly than I ever would have anticipated. So you can have something that I buy and that goes up kind of 50%, and then you're sitting there 6 months later and you're like, well, okay, I don't necessarily want to be turning over the portfolio this quickly. But on the other hand, right, as a valuation sensitive investor, even once you kind of think about the tax consequences and whatever, it's a little hard to want to own something that's trading, 30, 40, 50% higher than where you just bought it. When I don't feel like the fundamental situation has improved, to that extent, right? So I would say that in theory, my target would be, underwriting to a kind of 2, 3, 4 year horizon. In practice, just the market environment we've been in, it's stuff has been, kind of re-rating for the most part much more quickly than that. But I obviously don't think that would continue forever.
Sure. And then you said that you worked for a guy that invested in microcaps. Are you agnostic to where you look to invest in, like company size, or where do you typically
so that's always a fun discussion, right? On the one hand, you kind of have the purists who are like, there used to be a guy I know who's like, I'd look at large caps, he'd be like, why are you ever looking at a large cap? Then on the other hand, you kind of got the people who defend the all cap approach, saying that, look, the volatility in these big stocks, look at how much Google and Amazon move around in a year, and it's hard to say that there's not opportunities there as well, right?
Sure.
I'd say a few things. I think one is that, people are, I forget exactly how the Buffett or Munger quote goes. Here we are, first obligatory value investor reference to Buffett and Munger. But you can't do all things at all times, right? And so I think you kind of have to have some amount of focus, even as a generalist. Otherwise, it's just difficult to decide, like, okay, what do I work on next? So I think small and micro cap became my focus for a couple reasons. One is that, I do think empirically there do tend to be, better opportunities in that space, just because obviously larger funds scale out of it. Even successful small cap managers tend to take on a lot more capital, and especially the liquidity in some of these micro caps. Like, I was just kind of running a little analysis of what's in my portfolio and what's on my watch list, and it's not like the only thing I invest in, but in some of these sub sub $200 million companies, even if you're running $50 or $100 million, it can start to be difficult to build reasonably sized positions in those companies. So I do think there is a phenomenon of there being opportunities there for that reason. The other thing too, and I don't want to pitch it. I don't want to pitch it in terms of like, I think that everyone who doesn't invest in small caps is stupid. Like, I think there's plenty of reasons to invest in other things. I just think that this is something that I happen to have kind of developed a little bit of expertise in terms of it's easier to analyze some of these single segment companies, some of these market niches where it's a little harder to find information. But at the same time, I also think, just kind of from a business perspective, that I don't know what value I add to clients being the trillion and one guy to analyze Google or to analyze Facebook or to analyze Amazon, right? Sure. So it's not even so much that I have a view that those stocks are unattractive or attractive or whatever. It's just that it's like, okay, well, if you're going to pay for more than an index fees, right? I think that my value proposition is kind of unearthing opportunities that you wouldn't be able to find on your own, or that other managers probably aren't going to be looking at for you. And certainly I just have a really hard time kind of looking at Amazon or Google and Facebook. And yes, even if it's cheap, I don't know if that justifies me buying it and then putting my fee structure on top of it, if that makes sense, right? Because I think clients, I think you'd have to live under a rock to not know that Google and Amazon exist, and they're much cheaper ways to get exposure to those sorts of names.
Sure, no, I completely get it.
So certainly I think that there's a lot of I don't want to downplay. I mean, I do think there's a lot of empirical reasons to focus on small and micro caps, and that's one of the reasons I'm closing my fund at 50 million in AUM, is because I want to be able to continue to exploit that, what I view as that opportunity set. But on the other hand, certainly there are plenty of very talented investors who look at other spaces, and I've just chosen not to for a variety of reasons.
Sure, no, that's great. So then, what's your research process typically like? Which is always something that I'm always interested in. Like for example, like when you first get interested in a stock. Like this is the first thing you do is go read a 10K. Do you go to the SEC.gov website? Maybe take us through that process. Do you screens?
Let's drop some heresy here. So I hate 10Ks. I'm going to come out and say it, and I'm immediately going to get blackballed by 70% of value investors out there. I really, really, really hate reading 10Ks, and here's why. I feel like most 10Ks are written by lawyers for lawyers to satisfy kind of this checklist of disclosure requirements, right? Very rarely do I read a 10K and come away thinking, oh wow, I now have a phenomenal understanding of what's important to this business. I come away feeling, yeah, there's a checkbox, and this guy now told me that global warming may wipe out the global population, and now there's going to be no customers for the company, so their stock price may decline.
Sure.
And it's like, okay, not helpful, right? And obviously there's sections of the 10K that are very important for due diligence and whatnot, but my process typically starts by, if I can find the company giving an investor day or a presentation at like a sell side or industry conference where they're just kind of explaining, with more qualitative color what it is they do, that helps me understand whether or not it's even the sort of company that is within my wheelhouse or circle of competence, right? And so from that starting point, I would proceed then to use the filings for due diligence. But I find that the conference calls typically provide a lot more color in terms of just trying to learn about, like, hey, what does this company do? What's their strategy? What does management view as important? What's been happening recently? So that's typically my starting point.
No, I mean, I think I completely agree with that. Geoff and I, we recently did a podcast on like a checklist sort of to go over, or things to think about that's outside of the 10K to learn more about like the business. And because there's obviously a lot that, I mean, I kind of agree. A lot of what a 10K is, I feel like sometimes is copy and paste, quite honestly. And so sometimes, I think you could learn a lot about a business from, sort of, we talk about thinking like a journalist and kind of going outside of like the filings to learn about the company itself.
Right, and what's weird, and I don't want it to sound like I don't read the 10Ks, right? I mean, I read all the footnotes and all that. I do all the necessary stuff. But at the same time, it's like if you look at MD&A that's provided, on the financials, it typically contains a lot less explanation than the conference calls, right? Because the conference calls, I guess just because it's less regulated or whatever, and it's they cover their butts with the safe harbor. They just give you more color, and then analysts, of course, ask things. So a lot of times you'll get, things that the company doesn't necessarily want to like disclose with rigor on a regular basis, but just sort of directionally, like, okay, how much of your contracts are related to like this sort of customer or this sort of industry or whatever, right? And you can't find that in the 10K, but you can find that in the investor deck or in the conference calls or places like that. So I typically find those to kind of be a lot more helpful for starting, which again I know is non-traditional, but
no, I think that's great. So do you use screens typically, or how do you come across ideas that you're interested in and sort of decide to do more due diligence?
I don't know that I've ever really used formal screens. I mean, I'm sure it's something I could use. I just typically have had enough kind of lead flow without them. So, I mean, I think, first of all, like everyone else, I read, I do spend some time reading kind of investment write-up sites like Value Investors Club or Seeking Alpha or, whatever you want to call it. And I'm not necessarily looking for pitches, right? And we'll get into my process in a little bit in terms of the watch list, but I very rarely care about like, oh, is this a cheap stock or is this actionable today? I'm just more looking for, hey, is this an interesting business? Where like, if you're bullish on the stock and you're reasonably competent at what you do and you write it up and you can't give me a few reasons to actually be interested in the business model, then it's probably not a good use of my time to work on, right? So I do find that kind of a helpful filter in terms of like, okay, if someone really likes a company, if I don't even get interested in just the fundamental business, then it's probably not worth my time to actually do any primary work. Of course, then there's also what I call N+1 opportunities, which are like, I already know a sector, for example. So for example, I really love these these small cap kind of technical products, industrials that just sell these really niche products that are low dollar in context of customer budgets, but they're really high value or really big importance. I'll give you an example. So a stock that I've never owned, but I followed for a long time is Cadent, ticker's KAI. And, one of the things they sell, or one of their big product lines that they've historically sold, is these little blades that go into these big paper manufacturing plants. And these blades get replaced, like I think multiple times a day, or, every few days or something like that. And they're a big market share leader there. And obviously, these blades are not cheap. They're priced at a premium to competitors, but they're also high performing. And very few people are going to take the risk of, okay, let's save, relative pennies on this blade. And then our giant factory shuts down for 4 days because the new one screwed up, and now we're losing thousands or millions of dollars a day in downtime, right? So I like finding little companies like that just make these niche products that have kind of very strong margins and aren't too super capital intensive, and they have a good reputation in their industry. And so you kind of tend to encounter other companies just by kind of looking at those kind of companies, right? It's like, okay, well, who's upstream of them, who's downstream of them, who are their competitors, and things like that. And then, of course, there's also, I have friends who kind of know what kind of stuff I like, and will say, hey, I've been looking at this recently. This seems like it might be up your alley. So, variety of sources, but there's never, let me put it this way. My problem is usually too little time to work on interesting ideas rather than too few ideas to work on that are interesting.
Sure. No, and that's sort of how, Geoff, a lot of people bring ideas to you as well, right? Just people you've spoken with over the years, and they'll say, this may be a business that you're interested in.
Sure.
And they
Phil
kind of
Fisher
bring it to you.
said that's how he got his most interesting ideas.
Was people just bringing ideas to him?
Yeah, because I think it's the people know you, and so they bring you the kind of ideas that you like. They don't bring you ideas that aren't going to appeal to you. Yeah.
Yeah, that's
no one's going to be like, hey, Samir, Apple's trading at a great valuation.
Right,
You're like,
exactly,
okay,
yeah.
great.
Go check out Google.
I don't know what to do with that, but sure.
No, that's interesting. So you said, you like to follow the business, and I think we're sort of under that same mindset, how it's better to like the business first instead of go into it maybe because you think it's cheap, because sometimes you can confuse a statistically cheap stock with a margin of safety. So like for that situation, why have you never owned it? Is it because you just never got to the point of being cheap, or?
Oh, you mean Cadent?
Yeah.
Yeah, you can just look at the stock price, and you can just look at the EV/EBITDA multiple, or whatever you want to price it on, and then the thing just took off. Like, it was kind of when I started working on it, it was maybe close to a reasonable valuation, not quite what I wanted to pay, and then instead of getting more reasonable, it got less reasonable and less reasonable, and now it's so unreasonable. Or I haven't looked at it in a while, actually. I can't really speak to it, but certainly at one point it had gotten to just like a very, very expensive valuation. So I kind of stopped working on it for a while, and figure I'll come back to it at some future point when it's not so expensive.
No, but I think that's great. For investors to do and for everyone to listen. I think that's always my sort of advice, is to build up a watch list of businesses that you would love to own if the market gave you a chance, and then that's how you're able to actually like be patient and not give into the irrational swings of Mr. Market. You can almost use them to your advantage.
Yeah, and I was just, I think you put it well when you talked about confusing a statistically cheap stock with a margin of safety. I think the only modest thing I would add to that, you phrased it really well, is that you have to consider the behavioral angle, right? And that I'm big on the cognitive biases and stuff. And so I think that when you psychologically define success as, finding a cheap stock to put in the portfolio, it's easy to get frustrated if you aren't doing that, right? So, after working on a dozen stocks and none of them make it into the portfolio, there's a very strong temptation on that 13th to, find a way to make it cheap. And, when you want something, it's called desire bias, right? It really shapes your objectivity and kind of prevents you from seeing things clearly, versus when I view it as my job, like, hey, today I want to, find a new company and put it on my watch list, or, hey, this week I want to go back and review these 3 companies that have been on my watch list and see what's going on with them. That kind of makes it easier to be objective and to really kind of wait for the market to give me a fat pitch, or, whatever term you want to use. And of course, as long as you put some structure around that to make sure that you're not wasting your time working on stocks you're never going to own, I think that's at least for me, it's a more effective approach to making sure that only the best situations end up in my portfolio, as opposed to kind of the 52-week low list.
Sure. No, I think that's fantastic. So you sort of alluded to it a little bit earlier about your watch list process. What's that about?
Yeah, so basically I find, a couple things. One is that I just think that you learn a lot more about a business when you follow it longitudinally than when you try to do all the work at once. So, no matter how much time I spend on it, right? Like sometimes I'll spend 2 weeks working on one stock. Almost inevitably in 6 to 12 months, there are kind of initial things that I just either completely missed or that I misinterpreted or that I couldn't have known with the information that was available at the time, but kind of with things that came out after that, kind of became clear, right? And this isn't just me, of course. This is from talking to people who've been in the business for a very long time. So I just tend to find generally that I do better when I have followed a company or, even better, like a sector kind of or an industry for kind of an extended period of time. And so the watch list is really designed to allow me to do that, right? So when I'm looking for a new stock to work on, I'm not necessarily super sensitive to valuation because the goal isn't to get it in the portfolio today, right? And obviously, like if something's trading at 20 times EBITDA, it's unlikely that I'm going to waste any time working on it just because it's like, okay, well, there's no way I'm going to buy it at even 15 times EBITDA, right? So even if the stock were to decline materially kind of, over the next few quarters, the next year, whatever, it's still unlikely that I'd have a chance to work on it. But if you have something that's kind of trading within a reasonable range, so like, let's say, just ballpark for whatever reason, I think it's worth, and I'm just using EBITDA because it's easy. That's not necessarily what I use for valuation, but let's just say that there's a stock that I think is worth, 11 times EBITDA and I'd want to buy it at 8 or 9 times and it's trading at 12 times, right? It's like, okay, well, if they have a few bad quarters and or if that sector just falls out of favor and or, any number of other things, right? You and I have both seen stocks kind of go down 20, 30% on, a bad quarter or maybe 2 bad quarters. So with that sort of thing, it's like, okay, well, if I work on this, it's not a complete waste of my time because statistically, if I work on enough of these situations, again, back to mental models, the base rate is that I'm eventually going to get one that's cheap, right? And I don't necessarily know ex ante, if I work on 10 stocks, which of them I'm going to be able to buy in the next 3 years. But usually, if you work on enough stocks like that, 1 or 2 of them are going to get to a point that's really interesting for whatever reason. So that's kind of my approach, is just simply to say, okay, what are really interesting businesses that are worth following for the long term that I would like to own, but the price just isn't currently there, or maybe the price is there, right? I mean, of course, I do sometimes find stuff that's trading for cheap valuations, and it would be stupid to just say, oh, I'm not going to work on this because I don't ever, buy stuff the day I find it, right? I mean, there are certainly plenty of occasions when I've found stuff and very quickly put it in the portfolio. But typically I've started using kind of what I call a scale-in process where, and it's not super formal, it's not like there's really a big hard rule, but like typically if I've just looked at something, I don't want to make it more than a 2 or 3% position, right? And that kind of goes up by 2 or 3% per quarter that I've followed it. So there are a number of cases where I found something for the first time, made it maybe a 2 or 3% position, then, kind of after one quarter has gone by, add a little bit, after another quarter has gone by, add a little bit. Versus if I followed something for a long enough period of time, that kind of enables me to really go in, if I think I see the opportunity that I want, that I can go in a bigger size and kind of establish more of a fuller position versus scaling in over time. So yeah, that's kind of the watch list generally. And of course I've got, I guess the other portion is that I put in a fair value estimate that's not like, it's not set in stone, but it's just sort of like, okay, today I think the stock's worth $10, right? And so I'd like to buy it at a 20% discount. So rough numbers, we'll call it 8, right? So I put the stock in at 10, and then let's say the current price is 11, so my spreadsheet will tell me, okay, well today, this is 10% over your fair value estimate. But it does 2 things. One is it fetches the updated data, right? So it automatically fetches as the stock price changes, where the stock is. But second is it takes my fair value number and it compounds it by 10% a year, right? Because conceivably, if I'm underwriting things correctly at a 10% equity cost of capital, then if I buy a stock, if I think a stock's worth 10 today, it should be worth, again, rounding, it should be worth 13 in 3 years, right? Because it should generate $1 value kind of every, from a combination of cash flow and growth every year. And so obviously if the stock is at 10 today, well, maybe the stock doesn't move at all, but in 2 years, the fair value has moved up to 12, right? And so if you can buy a $12, intrinsic value for $10, that's actually something that I'd be interested in. So the spreadsheet kind of adjusts for that too. So it kind of gives me at any time, a good way of looking at, hey, here's where things are trading relative to what you thought they were worth. And so it's just helpful because anything that's kind of either, obviously below, but then even reasonably near fair value is kind of worth looking at too, right? Because sometimes things can go better than you think, or there could be a big acquisition that's transformative, but the market just kind of hasn't picked up on the value creation yet. And so the stock price may be higher, but the business value may have even increased faster than the stock price. So it's just very helpful in terms of prioritizing and allowing me to see okay, what is there out there in the world that I already know about that I should be working on, and then kind of if there's nothing there, that's when I move to like, okay, well, let's go find something new to put on the watch list, since there's nothing kind of that I already know about that's worth working on.
Yeah, especially like keeping track of everything and all these businesses you've done work on. That sounds like that's pretty efficient.
And it also really helps with the opportunity cost of capital thing, right? I mean, Munger talks about how everything is opportunity cost, and you really just have to measure everything against your next best idea. And so I think just having that all in one place makes it very easy, for me to look and say like, okay, so this is kind of cheap, right? So like right now I'm looking at a company that I really like the business model, but it has, there are some questions around it. And it has a little over 3 times debt to EBITDA, which is, more than I like to see, right? I'm very focused on conservative balance sheets. And so, in this case, it's not like the leverage is so high that I think the company's at risk. It's not like I wouldn't take a position, but it'd have to be a smaller position, and I'd kind of want to be more judicious about the price I paid for it. And so it's like, okay, well, if this is trading at like, a 16, 17% discount for fair value, it's like, okay, well, that's not something I'm going to stretch for when I have kind of all these other things that are above it on the watch list, right, that are cheaper with, either better characteristics or lower risk or, what have you. So it just makes it very, very easy to, it's not a conceptual exercise anymore of like, okay, well, I could invest in this, but what else could I use that capital for? I mean, it's very clear. Like, okay, well, here are literally the 17 other things that, my spreadsheet says I could use the capital for better. And of course, the spreadsheet isn't, set in stone, but it at least gives me an idea of like, okay, well, these are the other things that would be considered kind of in competition with that.
Sure. No, that's great. So I sort of want to shift gears here and talk about your website, which did you recently launch your mental model website?
Yeah, so it was July, like it was around July 4th.
Yeah, and that's actually how I came across you, was somebody told me about you, and because he knew that you were in the Dallas area, and that obviously Geoff and I were in the Dallas area, and I went to your website, and I probably spent a good couple hours, and that's how I actually read the book, Why We Sleep, was from your website.
I'm evangelizing.
That's right, and
read the book.
You changed my life. You changed my life, and I get better quality sleep. So maybe have
you been getting more and better quality sleep since you read it?
I have been, because I've been making it a priority. Yeah.
And what are the changes you've seen in your life?
Definitely I just feel more productive, and I could feel a huge difference between getting 8 to 9 hours of sleep instead of getting 5 to 6 hours like I was getting before. And
I know you're big on workouts. Does it improve your athletic performance too?
Oh, certainly. Yeah, no, definitely. Yeah. I don't understand how certain people, like, let's say our president, for example, that says he only gets 4 hours. He gets 4 hours of sleep a night or whatever. I can't do that. I wish I could and felt fine, but I just can't.
Yeah, so Walker talks about that, and so you can bring people into a sleep lab, and so there are actually a couple interesting things here, right? One of which is that people who are sleep deprived are like people who are drunk and tipsy at the bar and want their keys back, in that they're impaired and everyone else can see that they're impaired, but they don't know how impaired they are. Like, it's just very hard when you're sleep deprived to know how much that's affecting your decisions. And so again, sleep researchers, if you've had less than 7 hours of sleep, typically sleep researchers can bring you into a sleep lab and measure the impairment versus if they get you get a baseline 8-9 hours of sleep, and then they measure your performance on various kinds of tasks, both mental and physical. But what's also interesting is everyone knows that guy who's like, oh yeah, I get by on 6-7 hours of sleep and I'm fine. Well, what's interesting is there's two things. One is your baseline just resets, right? So you're just so used to feeling tired and crappy and whatever that you just kind of you don't realize how much better you'd feel if you did have sleep. But the second thing is there is a very small percentage of the population that for whatever reason has a gene that allows them to function properly with much less sleep than normal people. It's say 5-6 hours or something like that. But the scientists estimate that the likelihood of you having that gene is roughly equivalent to the likelihood of you being struck by lightning, right? So it's kind of like it's a rounding. I may be getting that wrong, but it's sort of a rounding error where it's like, yeah, we all know tons of people who say they're fine on 6 to 7 hours of sleep, but again, statistically, the base rate is that can happen, but it's just exceedingly rare.
Yeah, what do they call it? The I know a guy syndrome or something like that.
Something like that.
Yeah. How many hours a night do you get?
It depends. I would say on average probably about 9. I don't know. It really depends. I tend to sleep more the nights after I've worked out.
Yeah.
Sometimes 10 is not unusual. It depends on a lot of factors. It seems to vary, but certainly I think if it's less than 8.5, I am not super happy in the sense of like I know, and certainly south of 8, I start like actually feeling it. So
yeah,
it's a priority for sure.
That's hilarious. What about you, Geoff?
Same.
Yeah. So that's good. All of us are not sleep deprived, and we all feel great. That's interesting. So from on your website then, which obviously you use as a model, which everybody could check out as well. But your website is just an incredible treasure chest for people who are interested in mental models. And there's just such a plethora of information for people to learn from. So for anyone that's definitely interested, definitely check out your website. But what made you, I guess, sort of create the website and go through? I mean, were you doing it really for yourself to learn more, or, sort of talk about that process?
Yeah, no, absolutely. So I would say that, again, it's a mental model that sort of started this, right? And the mental model would be memory. And the joke that I like to tell people, and it's actually true, what started this website is that I was reading a book called The 7 Sins of Memory, and I was reading it for the third time. And Andrew, do you want to tell me why I was reading it for the third time?
I'm guessing because you didn't remember it anymore?
Yes, congratulations.
Yeah. You had to put it in your long-term memory, right? Isn't that what they say?
Yeah. So I mean, it's funny because I'm reading a book about, why our memories work and don't work in certain ways, and I'm reading it for the third time because I've forgotten everything it said, right? And so I kind of realized, like, okay, I spend half my life reading, it feels like, but I'm certainly, like, I hated the fact that I would read a book and I'd spend a lot of time reading it and thinking about it, and then I'd read another dozen books and I'd read another dozen 10Ks, and then by the time I was done with that, I'd be like, well, wait, I can remember basically the back cover copy, right, the summary of this book, but I can't remember any of the specifics. And so I figured out kind of maybe 3-4 years ago that I really needed to start taking notes on what I was reading, because otherwise I just was going to forget, right? And so I started doing that. And then along the way, I realized that if a lot of the value is not necessarily in a concept as a standalone, but when you start, Munger talks about kind of the Lollapalooza effect that happen when you start to get these mental models interacting. And so really it's interesting when you start thinking about how the models interact, right? Like, okay, memory and sleep, there's an interaction there in terms of, like, our memory works in a certain way, but if you're sleep deprived, it works, worse, right? And it's not for the better. And then how memory interacts with, like, corporate decision making in terms of, like, okay, memory combines with cognitive biases. You get, like, hindsight bias, where because our memories don't work, right, it's very easy to focus on an outcome and kind of have that aha, told you so syndrome, where something goes wrong and we're like, oh man, that was a bad decision, I never should have done that, because you don't remember at the time that it actually was a really good decision and the circumstances were completely different, right? And so that's just one example. And so you start getting kind of all these interactions. And so, unfortunately, as much as people talk about mental models and building a lattice work of mental models and whatever, there's just not really anything out there that I think people can go to if they really want to learn and they want to understand how these concepts interact, and they want to do that in a structured way. And so I started building it completely for my own purposes, just because I've always been a writer, and I find that when I write things down, I am better able to remember them. I then obviously can go back and refer to them. And then it was a pretty natural jump from there to, like, well, if I put in just a little incremental effort to sort of format this and write it in a reader-friendly manner, it provides a lot of value to a lot of people. And of course, for me, right, it provides a platform to meet and interact with interesting people. So, like, I wouldn't have met you, right, if it hadn't been for the website, because, Joe read the website, and then Joe was like, oh, Andrew would love this, and he's in Dallas, and I'll send it to Andrew. And so,
exactly
Joe reads it, and then he sends it to you, and you read it, and then we meet up, and now we're friends, right? So, it's a really useful networking tool, I think, in the sense of introducing me to people who are thinking about the world the same way I am, which is something I think we all, really want and derive value from.
No, I think that's absolutely incredible, and everyone definitely needs to check that out, and we will put that link, obviously, in the show notes. So, and you also do book reviews on there as well, correct?
Yeah, and so that's the idea, is to be vertically integrated, right? Because when I think about how I learn, it's primarily through reading books, and of course I read some long form articles too, right? So, like, New Yorker type stuff, but mostly it's books. And one of the things I find is that, again, just like with companies, right? There are so many books out there. I mean, you can go on Amazon and I could fill up my entire house with books.
I was gonna say, do you read hard copies, or do you have a Kindle?
No, yeah. So I read hard copies, and I know a Kindle would totally be. I mean, you're going to laugh. I went on a backpacking trip, and despite the weight, like, I was carrying like 3 books, which like the ultralight people would just, like, they'd roll their eyes. But yeah, I mean, for me, part of it is that I just spend, like, my entire life staring at a screen anyway. So I just kind of like literally the physical kind of break of, like, not looking at a screen and looking at a book. Then there's also the fact that I'm a value investor, and you can get used books on Amazon for usually, like, a couple bucks plus another few bucks in shipping, versus, like, Kindle books are usually like 10, 12, 15 bucks. And saving $5 a book doesn't sound like much, but when my Amazon bill is embarrassing. Like, I don't spend money on pretty much anything else besides besides food and coffee. But the amount of money I spend on books is really truly staggering. So it does add up.
Yeah, Geoff has said that. You've said that before, right? That every year you look at to see what your most expenditures were on Amazon, and it's always books.
Yeah, I don't even look. I just don't. It's. I mean, my friend Clayton, who Geoff, I know you know Clayton, but Clayton used to talk about, like, I think when he was a kid he had an allowance, but something like his mom like would basically give him as much money as he wanted for books, and I kind of view it the same way. Like, I'm frugal and I don't spend much money, but like when it comes to a book, unless it's like a really really expensive book, like I'm not going to buy Klarman's Margin of Safety, but pretty much anything south of that, like if it's a book and it's not $500, I'll buy it.
And it's almost like, I mean, obviously I've been reading on a Kindle too. More recently, but I do like hard copies because it's almost like it's a trophy in a way. I feel like there's just some sort of satisfaction that comes from once you read it and you put it on the bookshelf or whatever, just seeing that you read it and being able to reference it in the future and stuff like that.
Yeah, I mean, I'm not dogmatic. Like, I do buy Kindle books sometimes, and I know plenty of people who get value from it, and I certainly would not argue with the efficiency, right? Like, being able to control F is huge. Like, one of the biggest annoyances with the physical books, or really any physical printed material, is not having control F, because like it's so annoying when especially when I was building the site, and like I would know that there was some reference somewhere that I wanted, but like I couldn't find it in my notes, and I couldn't just go search for it in the book. But so I mean, the book reviews on the site are really for the purpose of helping people understand, like, okay, if there's a specific model or a specific topic or a specific category you're interested in, right? Like, investing books aren't really covered on the site, but it's like, okay, there's a million books in any category. Which are the ones that kind of derive the most value per page for the user? Because unfortunately, right, there are a lot of books that have a lot of useful information, but it's buried in so much, irrelevant detail that you kind of never get to it, or you can't find it, or there's books that are just really poorly written. So for example, like it always astonishes me that Kahneman's Thinking Fast and Slow is ever recommended by anyone, right? Because obviously, Kahneman's research is top notch and he deserves, all the praise he gets as a researcher, but his book is just like incredibly dry and dull and repetitive, and it's not practical or applied at all, right? Versus Thaler's Misbehaving, which covers, pretty much the same ground, but it's hilarious, it's witty, it's really practical, it talks about how you can use it in your everyday life. So it's like, okay, if you're going to spend a certain amount of time learning about behavioral economics, like, why not do that in a fun way that you're actually going to remember? Because again, memory mental model, things that you enjoy, you tend to remember a little bit better than things that are really dull and boring, which is why I've forgotten, everything I ever learned in college.
Yeah, sure. That's great. I guess, what is your favorite book, by the way?
I mean, it depends. I think the three that I name on the site, Why We Sleep is obviously one. I call it the most important book of the century, which I really don't think is hyperbole. Misbehaving is probably my favorite book, just in terms of like, it's really funny. Like, I'm not kidding. Like, Thaler could be a stand-up comedian, and it's super educational. The Design of Everyday Things is also, I think, a really important one. And I don't know if we're going to get into it here, but I did a podcast with, John Mihailovich of the Manual of Ideas a while back, where we talked about it a little bit. But just this idea of structural problem solving, where like, Norman kind of talks about, a lot of people, when they are faced with a problem, they assume it's the user's fault, right? It's like these engineers designed this washing machine that has 7 trillion buttons, and then they're frustrated that the users can't figure out, which of the buttons to press in which order and which combination, right? It's like one of those video games from childhood where it's like, oh, if you want to do this sword combo, it's like A and then Y and then X and then, the right bumper or something. And you have to hold the stick in a certain direction. And obviously, right, like you can try and force people to learn all this stuff if you're designing a product, but you can also just sort of accept that people are the way they are and design a product for real people instead of these fictitious, what Thaler calls econs, right? Which are people with unlimited willpower and unlimited memory and unlimited knowledge, and none of us know these people. And so the Design of Everyday Things is really about consumer products in terms of like, how do you design a good door, or how do you design a stop sign that works well, or whatever. But the idea behind it, right? Again, going back to mental models, this idea is totally applicable in other fields. And so Thaler, if you read his books and you look at his Nobel Prize, he mentions it several times that he actually, Don Norman's The Design of Everyday Things was a guiding principle for him. And so Thaler, along with some colleagues, designed this program called Save More Tomorrow, which, long story short, helped people save like 6 times the amount for retirement, or just something. It's incredible. I mean, then you add compounding in, right? And they did that by basically understanding the mental models and kind of using structural problem solving to say like, okay, well, how do we take these and turn these into pluses instead of just banging on people's doors and saying, hey, save more, save more, save more? How do we create a system that encourages them to save more, right? Without them, having to exert any willpower. And so, I think those are probably my 3 favorite books. That's, it's hard to choose. There's so many. Honorable mentions. I love Lawrence Gonzalez Gonzalez's books about cognition and intuition. So he has two. One's Surviving Survival, the other's Deep Survival. He's a great writer and, super informative too. But yeah, there's so many good books out there. I haven't even scratched the surface.
Sure. And how did you get into like mental models and everything? I mean, I'm assuming a majority or of the interest came from like Charlie Munger and obviously Warren Buffett and being a value investor and stuff like that.
Yeah, I mean, I think it sort of predates that in the sense that I probably was already thinking along those lines, and then I encountered the Munger and Buffett terminology, and it just gave me a way to organize what I'd already been thinking about. But certainly, it was just sort of I'd had this idea for a long time of like, okay, well, if you can just sort of figure out how the world works, right, and figure out these organizing principles, then you can apply them repeatedly. And so, like, one of the interesting things that had always bothered me as kind of a teenager and a young adult was like why people seem to not apply the same lessons from business to life, right? And I think that's something that Munger talks about really well, is that like, well, the principles apply everywhere, right? And there's a difference between principles and practices. Like, obviously you don't necessarily talk to your 8-year-old kid the same way you talk to your employees or the same way you talk to your boss or your clients. But the idea of empathic listening, right? That's a principle that sort of transcends all those individual situations, and you apply it differently. But the whole Dale Carnegie stuff, that works no matter whether you're talking about like, trying to make a new friend or, trying to get your family to do something, or trying to advance yourself in the workplace, right? So, yeah, but that's definitely where it came from.
Sure. No, that's interesting. So I think we're going to kind of bring this to an end here. And I was, obviously when I was doing some due diligence for this podcast, I was going over your pitch book and just a few different things. And in your pitch book, you said, please ask me about my mistakes and what I've learned from them. So I'm kind of curious to hear about, some of your mistakes and what you've learned from them and, sort of what your takeaways were for them.
Yeah, sure. I guess I'll categorize this in two ways. And I guess the first is investment mistakes, which are probably less interesting. But so prior to launching, since launching Askeladden, I've been very fortunate in that obviously the market's been very conducive, and also I've just, the investments I've made have worked out. Whether that's skill or luck is an open question. But, before launching, I certainly had a lot of failures in my personal portfolio that were very obviously me making mistakes, like investing in companies that were, heavily leveraged or had bad management or had, cyclical, very cyclical end markets, and I kind of didn't size the position. It's not necessarily bad to invest in companies with some cyclicality, but it is bad to sort of, assume that the cyclicality is going to go your way, right? So I think those are all, fairly obvious lessons, and in a different context, I'd be happy to chat more about that in terms of the investment side of it. I think personally, the biggest mistake I've made, and the one that continues to be a challenge, I think not just for me, but for a lot of people, is separating the world that you want to exist from the world that actually exists. And so it's that desire bias thing that I was talking about, which is, one of the models. But so, for example, I kind of want, I really prize, kind of strong relationships and civility and kind of kindness and things like that. And I want the world to be a place where, you get ahead by sort of being nice and doing the right thing. And if you do that, then everything will work out, right? And I think what I've come to find is that that is true much of the time. And certainly I think it's adaptive to behave in that manner. But just because you do all the right things doesn't guarantee that you're going to get a right outcome, right? And there are bad actors out there who will take advantage of you and who, no matter how much you try to kind of help them and do the whole Dale Carnegie thing, they just aren't going to respond, right? And so, I think the formal game theory angle on it is that, like, in a game like Prisoner's Dilemma or whatever, right? Like I think tit for tat is sort of the evolutionarily adaptive strategy, but you can also just cheat all the time, right? And if someone cheats all the time, there's no way to beat them by playing nice. You kind of just have to respond. So it's kind of interesting, but I think the biggest lesson I've learned, and that's just one example, right? But the takeaway is that, whether it's as an investor or whether it's as a person, it's just really important to sit down and think about, like, okay, am I seeing the world this way because it's the way the world really is, or am I seeing the world this way because that's the way I want the world to be? And so I'm selectively cherry picking the data points that support that worldview and kind of conveniently ignoring the ones that contradict that worldview. So for example, right, an example of that would be, I believe in work-life balance, right? But of course there are cases where I think that, working longer, working harder, or whatever, is important. And you have to kind of be careful not to start with your thesis and then, go through the confirmation bias thing and just kind of selectively confirm it. So yeah, those are some of the ones that I think would be top of mind.
Wow, Samir, thank you so much. I mean, that was incredible. And, obviously Geoff and I, we can't thank you enough for coming on the show. It was interesting because I was actually more interested in everything else about you than actually talking about like your investment process and your fund and everything like that. I mean, you're just, with your models and everything, it's so interesting. And obviously we can't thank you enough for coming on. How can people get in contact with you if they want to reach out?
Yeah, so email is good. My first name Samir at Askeladden capital.com. Obviously, I think you're going to post a link to the website, and so the website's there, and they can read all that, and there's a lot of information there. And I don't actually, you mentioned I don't have a Twitter. I actually do have one now, but it's only to like do an automated I don't ever use it. It just automatically like posts new things that I post on the website because it drives engagement and whatever.
Okay.
And,
we're gonna get that.
Maybe my story includes Twitter at some point in the future, but I'm still trying to bring back the long email, and so there's a little bit of a
it's a little different
conflict between that and 140 character, or I guess it's 280 now. But
yeah.
Twitter's just a hard platform for me because it's just so not.
You'd be tweeting, you'd be going on like 10 different threads.
It's not long-term greenfield value, right? It's like it's not something that's going to be worth something in like 10 years. It's a bunch of like 24/7 type. I don't know. I know there's a lot of people who derive a lot of value from it, so I try to be careful not to pan it too much. But certainly, I've not. It's not something I'm interested in engaging in personally.
That's so funny. That is hilarious. Cool, man. Well, I really want to thank you so much for coming on, and we definitely want to have you come on in the future. And if you do decide to turn over to the dark side, we'll help you out. Link people to your Twitter so they could follow you. You may actually like it.
Well, you can give them my Twitter, and it'll give them an automatic feed of whatever I post. It's at Askeladden TX for Texas. So that's all it is. It's pretty simple, but yeah, it's very bare. It's not fancy.
Perfect. Samir, thank you so much for coming on.
Yeah, thanks. Appreciate it.
Perfect. Well, we hope everybody enjoyed this podcast. This was one of our first times of having an individual on to talk about them and their investing process and other things related to that. This is something that we probably are going to be doing in the future. It was a lot of fun for both Geoff and myself. If you do want to get access to our investing idea website, feel free to go to focuscompounding.com. And if you do sign up, use the podcast promo code, which is podcast. And what they'll do is take $10 off of the monthly price indefinitely, as long as you do stay a member. Also, Geoff sends out a weekly memo on investing principle every Sunday. If you do want to get access to that and have that in your inbox, feel free to enter in your email on our homepage, and then that will allow that memo to be reached to you. Other than that, thank you very much. Everybody have a great week, and we'll see you in the next podcast.